Back in October 2025, we released an analysis on private credit, predicting it would exert significant pressure on the markets in the months to follow. To be precise, our forecast called for one final upward surge in the markets in either late 2025 or early 2026, just before the deep-seated issues within private credit began to drag asset prices down. As it turned out, the S&P 500 and the Nasdaq both peaked in late January 2026 and now appear to be on the verge of rolling over. We certainly weren't the only ones sounding the alarm. JP Morgan CEO Jamie Dimon also warned that more, in his words, cockroaches, would emerge from the private credit sector. It seems we were in good company in warning that this very sector could ignite the next financial crisis. Now, former Goldman Sachs CEO Lloyd Blankfein and other influential figures are echoing the same concerns. The entire situation is beginning to look eerily similar to the prelude of 2008. But how did we arrive at this point? For a quick recap, private credit encompasses any form of lending that occurs outside the traditional banking system. If I were to lend you money personally, that would technically be a form of private credit. Of course, the system we're dissecting here is infinitely more complex and opaque, involving institutional investors who borrow from banks, lend that capital to businesses, and then often package and sell those loans to other investors. As many of you will recall, the private credit market began its exponential growth following the 2008 financial crisis. New regulations, such as the Dodd-Frank Act, were implemented to de-risk the banking sector, restricting banks from lending to higher-risk borrowers like small and medium-sized businesses. This created a vacuum that private credit firms like Apollo Global Management, Blackstone, and Blue Owl Capital eagerly filled, effectively becoming the new de facto middleman for riskier clients. What you might not realize, however, is that the private credit market isn't colossal in absolute terms. Its estimated value is somewhere in the $3 trillion range. To put that into perspective, public credit markets are valued anywhere from $40 trillion to $145 trillion, depending on how you define them. So, how can a relatively small market have such a potentially devastating impact on the entire system? The answer lies in two critical words: complex and opaque. This combination means that no one has a complete picture of who is lending to whom, the specific terms of these loans, or even what these assets are truly worth. This opacity became a serious problem when obscure companies deeply intertwined with private credit, like First Brands and Tricorbron Holdings, went bankrupt in September of last year. Suddenly, investors were forced to ask uncomfortable questions. Who had exposure to these failed companies? Which firms would be next to fall? And is the yield from private credit really worth the underlying risk? The answers began to surface not long after our October video. By November, major private credit companies started facing a rush of redemptions. They managed to meet these demands by using a combination of new capital inflows and their existing credit lines with banks. But the anxiety persisted through December, with Morningstar issuing a caution that more defaults in the private credit space were inevitable. The first major crack appeared in February of this year, when Blue Owl Capital's cash reserves ran low. The firm was forced to begin selling the very illiquid assets that its own investors were desperately trying to exit. In retrospect, it was clear that Blue Owl would be the first major player to show signs of stress. As we noted in our previous video, PayPal had offloaded $7 billion of its high-risk buy now, pay later loan portfolio directly to Blue Owl. Famed economist Mohammed A. Alarian described Blue Owl's forced sale of illiquid assets as a canary in the coal mine moment, drawing a direct parallel to the summer of 2007. For context, that was when two Bear Stearns hedge funds heavily invested in mortgage-backed securities collapsed. This event sparked a panic in the markets, forcing the Federal Reserve to provide emergency liquidity, which in turn triggered one final rally before the Great Crash. However, as we explained in our previous analysis, we see the timeline a bit differently. We believe the collapse of Tricorbron Holdings and First Brands last September might have been the actual canary. That event was the reference point we used to predict the subsequent market rally, a rally that was further supported by the Fed's, not QE, liquidity injections that began in December 2025. This was, in effect, a subtle form of emergency stimulus. In other words, it appears the private credit crisis is already in an advanced stage. This implies that the final rally may have already occurred, and what lies ahead is the main event, the crash itself. This begs the crucial question of where we are in this process, and what we can expect to happen next. Before I give you that answer, you should check out our free weekly newsletter and some of the finance-related deals we've arranged for our viewers. Just click the link in the description or scan the QR code on your screen. And while you're there, if you're enjoying this video, please hit that like button, subscribe to the channel, and ring the notification bell so you don't miss our next update. Now, to understand how advanced this crisis is and what's coming, it helps to view it through a series of stages. This is where analyst Jeff Snyder comes in. Snyder is one of the few macro experts who was discussing issues in private credit long before it became a mainstream topic. He developed a framework consisting of 4 distinct stages to help make sense of the progression. The first stage begins when an event triggers concern and causes the capital that was flooding into private credit to start flowing out. You'll recall that this inciting event was the collapse of First Brands and Tricorbron Holdings last September, which led to exactly that, widespread concern, a barrage of questions, and a surge in redemption requests from private credit funds. The key to Stage 1 in Snyder's framework is that this surge in redemptions doesn't initially cause any systemic issues, as the funds are still able to honor them using money from various sources. This is precisely what we saw last autumn, as firms used a mix of new investments and bank credit lines to meet redemptions without a problem. Stage 2 is what began recently. This is when private credit firms start running low on cash and are forced to sell other assets to honor investor redemptions. This happens because new money slows to a trickle and banks become unwilling to extend further credit. The situation escalates from simply selling assets to a forced selling of assets, which almost always means they are sold at a steep discount, a very negative development. For instance, imagine Blue Owl had to sell its portfolio of buy now, pay later loans at a significant loss. Instantly, other private credit firms holding similar loans would face their own surge in redemptions, as their clients would start to question their solvency now that the market value of those assets has been publicly marked down. This creates a vicious cycle of even more forced sales. Stage 3 occurs when this forced selling spreads to other private credit firms holding different, less risky types of loans. This is the point where investors as a whole throw up their hands and say, "We don't care about the nuances anymore. We're concerned about the entire private credit asset class, and we want our money back now." This is when you would start to see outright bankruptcies of private credit firms, something that has not happened yet. Notably, Snyder refers to Stage 3 as a credit crisis. This means that while private credit firms may start to fail, the contagion hasn't yet spilled over into the broader economy to cause more systemic issues. As such, you can think of Stages 1, 2, and 3 as a crisis that remains relatively isolated. It's not yet a 2008-style liquidity crisis. That distinction, however, assumes that Stage 4, the final stage, never happens. Stage 4 is the liquidity crisis. This is the catastrophic phase when a credit crisis begins to infect sectors of the market and the economy that it shouldn't. In our current scenario, this would mean bankruptcies within private credit spilling over and causing systemic failures elsewhere. Whether we reach Stage 4 fundamentally depends on one question: who has been doing the lending? Who is left holding the bag when all the money they've lent out is lost? To refresh your memory, the private credit market is worth around $3 trillion. As you might expect, institutional investors are the primary lenders, accounting for 76% of the capital. What you might not have guessed is which institutions are the biggest lenders: pension funds, insurance companies, sovereign wealth funds, and other entities that you would assume should be avoiding such risky investments. Instead, they have been going all in. This is where the situation gets both interesting and terrifying. If you watched our recent summary of Cathie Wood's viral report on how AI will disrupt the markets by 2028, you'll recall we pointed out that much of the report felt like a commentary on today's events, despite being set in the future. That report contained a section specifically about private credit, and it provides an almost perfect explanation of how a credit crisis could metastasize into a full-blown liquidity crisis. It perfectly illustrates how problems in private credit could spill into the broader financial system. Quote, "Private credit is not 2008 banking. The whole architecture was explicitly designed to avoid forced selling. These are closed-end vehicles with locked-up capital LPs committed for 7 to 10 years. There are no depositors to run, no repo lines to pull. The managers could sit on impaired assets, work them out over time, and wait for recoveries. Painful, but manageable. The system was such that it was supposed to bend, not break. Over the prior decade, the large alternative asset managers had acquired life insurance companies and turned them into funding vehicles. Apollo bought Athene. Brookfield bought American Equity. KKR took Global Atlantic. The locked-up capital that couldn't run was life insurance policyholder money. And the rules are a bit different there. Compared to the banking system, insurance regulators had been docile, even complacent. But this was the wake-up call. Already uneasy about private credit concentrations at life insurers, they began downgrading the risk-based capital treatment of these assets, and that forced the insurers to either raise capital or sell assets, either of which was possible at attractive terms in a market already seizing up." Close quote. Again, this was presented as a hypothetical scenario triggered by AI, but it's easy to see how this exact domino effect could play out today. The key takeaway is that private credit has become deeply intertwined with the insurance industry, a sector worth over $40 trillion. The reasons for this are fascinating. Beyond insurance companies investing their own capital in private credit, the private credit firms themselves have been acquiring insurance companies, as the report noted. This strategy was famously pioneered by Berkshire Hathaway, which has been acquiring insurers since the 1960s, using the incoming insurance premiums to finance its long-term investments. The mechanics are brilliant. Insurance premiums are paid consistently, usually every month, but insurance payouts for claims can take months or even years. This time lag creates a pool of capital, known as float, that can be invested to earn a return until it's needed to pay out claims. This is precisely the model private credit firms have adopted. The critical caveat, however, is that they are investing this insurance float in private credit markets, which are not only complex and opaque but also highly illiquid. This creates two potential paths to a financial crisis. The first is a major catastrophe that results in a flood of simultaneous insurance claims. The second, which appears to be unfolding now, is that the value of the private credit loans held by these insurance companies collapses. As we've just learned, the second scenario is already in motion. Private credit firms are facing a wave of redemptions, leading to the forced sale of their assets, which in turn is pushing down the prices of those assets. If insurance companies have significant exposure here, they will suffer major losses. If those losses are severe enough, the insurance companies themselves could begin to collapse. And this is where the truly scary part begins. If you examine the stock charts of insurance companies with heavy investments in private credit, like Corebridge Financial, you'll see they have all been collapsing. This isn't entirely surprising, as most stocks affiliated with private credit have been under severe pressure lately. What is more alarming is that other, broader insurance company stocks are also starting to look weak. The State Street Insurance ETF, ticker KIE, has been forming a massive topping pattern since late 2024 and looks poised to roll over. This could be evidence that the contagion is spreading to the insurance sector more broadly, not just to the firms with direct and obvious private credit exposure. There's another ticker flashing a major warning signal, Berkshire Hathaway. While not purely an insurance company, Berkshire owns multiple insurers and uses their premiums as a primary engine for its investment machine. As you can see, Berkshire's stock, BRK, is painting a massive head and shoulders pattern that extends all the way back to mid-2024. This could be a sign that the distress in the insurance sector is threatening to spread to even larger, more diversified parts of the market, a clear signal that a stage 4 liquidity crisis is approaching. But before you panic, it's vital to remember where we are in this process. By Snyder's estimation, the private credit market has been in stage 1 for about 6 months, meaning it's been half a year since investors first got spooked and began withdrawing capital. Stage 2 only began this February when Blue Owl became the first, but likely not the last, firm to become a forced seller of assets. As Snyder has repeatedly underscored, there is no guarantee that Stage 2 will evolve into Stage 3, or that Stage 3 will inevitably lead to Stage 4. The progression is not clear-cut and can take a long time to unfold. It's also entirely possible that the crisis remains contained within the private credit markets, and Stage 4 never materializes. However, the likelihood that we reach Stage 4 appears dangerously high given the current circumstances. Investors are already rushing for the exits out of an abundance of caution. Continued geopolitical escalation in the Middle East and persistent uncertainty around issues like trade tariffs are only making investors more eager to de-risk. Add to that the rising probability of a hawkish Federal Reserve, and you have more fuel for a growing fire. With all that said, there is one thing that could save the day: central planners appear to be fully aware of what's going on. After all, the Fed provided its, not QE, liquidity back in December, specifying that it was to manage market liquidity. The private credit story has also been gaining traction in the media since last autumn and is now starting to make front-page news more frequently. This heightened awareness means we are likely to see more official efforts to support the private credit markets in the coming months, all in an attempt to prevent this emerging credit crisis from becoming a full-blown liquidity crisis. There are just two massive problems with any potential bailout. The first is how to ensure this liquidity actually finds its way into the specific pockets of the private credit market that need it the most. The second is how to introduce this liquidity without triggering widespread panic. Unfortunately, there is no elegant solution to the first problem. The private credit market is simply too complex and opaque. All central banks and governments can do is flood the entire system with liquidity, and hope that some of it trickles down to the sectors on the brink of collapse. This, by the way, is an almost identical dilemma to what central planners faced in the summer of 2007. They knew there were problems in the mortgage-backed securities market, but they didn't know exactly where the vulnerabilities were. So, they just flooded everything with liquidity, hoping it would be enough. That action is what ultimately caused one last leg higher in the markets in late 2007. By early 2008, it was clear the initial stimulus hadn't worked, and the credit crisis morphed into a liquidity crisis. As we learned then, that initial stimulus also inadvertently fueled panic. By going so far out of its way to provide emergency liquidity, the Fed confirmed to the market that yes, the problems in the financial plumbing were real and severe. This brings us to the second problem. How can central banks provide the massive stimulus needed to fix private credit without signaling to the world that the system is on the verge of collapse? Some might argue that the only way is to have another crisis occur, an external shock that provides the perfect justification for a massive injection of liquidity. Something like, for instance, a sudden war that escalates far beyond what investors were expecting. On a completely unrelated note, you should check out our recent video about how a war with Iran could impact the global economy. The link is right here in the top right corner. Thank you for watching, and I'll see you again soon.